Jim Fink is Chief Investment Strategist for Jim Fink's Options for Income, as well as the market-beating small-cap investment service Roadrunner Stocks. Jim holds a bachelor's degree from Yale University, a master's degree from Harvard's Kennedy School of Government, a law degree from Columbia University, and an MBA from the University of Virginia's Darden School of Business, where he studied the value investing principles of Warren Buffett and Sleth Carman. He is also a lawyer and a member of both the Illinois and DC bars. For investment credentials, in addition to his MBA, Jim holds the right to use the Chartered Financial Analyst designation. Jim learned the art of options trading from CBOE, market makers, during his decade-long residency in Chicago, Illinois, the world capital of derivatives markets. According to Jim, the secret to successful options trading is selling time value decay, the only certainty in life besides death and taxes. Jim has traded options for more than 20 years and has generated personal profits of more than $5 million. So without any other delay, let me go ahead and introduce to you our final speaker for today, Jim Fink from Investing Daily. Jim, go ahead, take it away.
Thank you, William. It's a pleasure to be here today. And I think now is a very critical time in the markets, and the type of option strategies that I employ in my Options for Income service are perfect for the current market environment. So I'm very excited to be here and share these ideas with you. The title of my talk is The Options Miracle System, How to Generate 30% Annualized Returns in a Stagnant Market with Limited Risk. I am the Chief Investment Strategist at Jim Fink's Options for Income. You can find out more about my investment service at www.investingdaily.com/webinar. That's what I look like if you care. I am a real person. Okay, why is now a good time to be trading options in a risk-averse manner? Stocks are significantly overvalued. Yale economics professor James Tobin, who I had the privilege of being a student of at Yale back in the 1980s, developed a valuation measure called the Q ratio, which is the market price of stocks divided by the asset replacement cost. Now, this is similar to the book value measurement, but it's actually better because it uses current market values and not accounting values, which are usually historical and much lower, so it's more accurate. James Tobin is no longer with us, but his Q ratio is currently maintained by Andrew Smithers, who is a United Kingdom money manager, and you can check on the current value at his website. Based on the Q ratio, the stock market is very overvalued. The Q ratio is way above its long-term average. Actually, it's 75% above its long-term average. It's right near the overvaluation peaks at the beginning of prior bear markets. A similar market valuation measure is Robert Shiller, another Yale professor. He's still alive. His cyclically adjusted 10-year PE ratio is currently around 28.4, which is much higher than the long-term average of 15.7. So according to the CAPE, which is his measurement, the market is 81% overvalued. So there's a tremendous amount of risk in the market. Market cap of the stock market to GDP is Warren Buffett's favorite valuation measure. Quote, the percentage of total market cap relative to the U.S. gross domestic product is probably the best single measure of where valuations stand at any given moment. Right now, U.S. gross domestic product is about $16.8 trillion. The total market cap of U.S. stocks is $19.8 trillion. That's a 118% ratio, meaning the stock market is valued greater than the U.S. economy. Since 1970, only 3 times has the market cap of the stock market equaled or exceeded gross domestic product. Back at the internet bubble of 1999 to 2000, it was the most overvalued, 148% of GDP. Nasdaq subsequently lost 78% of its value. Then in 2007, the ratio was 111%. The S&P subsequently lost 56% in the 2008 financial crisis. And right now in 2014, the ratio is 118%. So it's less than the internet bubble, but more than the 2007 market top. So you know, we're at a very precarious moment in market history. Economics PhD John Hussman, quote, since the 1940s, the ratio of equity market value to GDP has demonstrated a 90% correlation with subsequent 10-year total returns on the S&P 500. The present level is associated with annual total returns of only 1.8% annually. So there's not much appreciation potential from a buy and hold stock strategy, so you're going to have to do something else. Options is that something else. Now, there are other warning signs. One that I like is the Nasdaq to NYSE relative strength ratio. I misspelled NYSE, so disregard that. Dropped decisively below its 10-week moving average for the first time since late September 2012. The market performs much better when Nasdaq stocks are outperforming the NYSE stocks. And as you can see, let's see, right here. This is in the March-April period of 2014. Nasdaq stocks and small cap stocks significantly underperformed New York Stock Exchange stocks, and that has historically suggested that investors are becoming more risk averse and are ready to sell stocks at a moment's notice. Since May, there's been a nice recovery in the Nasdaq relative strength performance, but it has not gone back to its previous high in early March, so you could argue that this is a lower high that is going to go back down again and cause a significant correction. Okay, so University of Michigan finance professor Najat Sahunin says he's an expert in insider buying and selling. He says, insider selling is as pessimistic as I've seen in over the last 25 years. This is more pessimistic than in 2007 and more pessimistic in 2011, both of which were right before bear markets. So insiders are bailing out of this market like he hasn't seen in 25 years. Also, the investor intelligence bull-bear ratio has been above 3 for most of the past 5 months, which is longer than any time since the 1980s. In other words, investment advisors are more bullish now than they have been in 30 years. And as a contrary indicator, when everyone's bullish, the market has nowhere to go but down. But in the short term, the market still looks strong based on this IV portfolio market timing system, which basically looks at how the S&P is trading in relation to its 10-month moving average. And right now, the S&P is still trading comfortably above its uptrending 10-month moving average. So on a short-term basis, it's still a bull market, as we all know. But the danger signs are out there. Now, why is it important to guard against losses? It's because there's a loss-gain asymmetry. Of all the slides I show you today, this is probably the most important to remember. It's the most basic information of investing, and that is, whatever you lose, you got to make back more than what you lost. So that's why losses are more important than gains. If you lose 30%, you got to make back 43% just to break even. If you lose 50%, you've got to make 100% to break even. So if you can avoid these losses, you're going to come out ahead, because the damage caused by the losses is often almost impossible to recover from. So how do options help you? There are 3 basic strategies that you can use options for. You can sell low probability fear, which is selling out of the money put options. You can buy high probability growth, which is buying in the money call options. Or you could sell low probability greed, which is selling out of the money call options. All 3 of these strategies work. Now, what makes my options for income service unique in the industry and gives my subscribers a leg up, an edge over almost anybody else is one of our software applications called the 10-year stock seasonality navigator. And what this means is that seasonality refers to particular time frames during a calendar year when a company's stock price is influenced by recurring forces that produce consistent price direction, either bullish or bearish. Simply put, some stocks tend to go up consistently at certain times of the calendar year. For example, consumer-related stocks like food, drugs, beer, leisure, utilities, media, and retail outperform the overall market between May 1st and October 31st, the summer months. Whereas manufacturing and production stocks like consumer durables, chemicals, construction, mining, and steel stocks outperform during the winter months between November 1st and April 30th. Now, these seasonal tendencies can be based on weather events, spending surges, new product announcements at industry conferences, which happen at the same time every year, or financial events, which happen at the same time every year. You don't always understand why these seasonal patterns exist, but they do. This is what the Seasonality Navigator looks like on the Options for Income website. On the left-hand side, it shows you the frequency of stocks outperforming between a certain start date and a certain options expiration date. Here, the start date is 12/18/2013. You can see in the top left corner, December 18th. And then it shows you the next 6 expiration cycles, starting with the January 2014 expiration, going all the way out to June 2014. And it sorts stocks by how often they have outperformed, gone up. For example, as you can see, LNKD, the third one down, LinkedIn, it has risen between December 18th, 2013 and February, January, and March, all the months actually, 100% of the time. So that 100 number means 100% of the time. Going down, you can see, for example, PNRA, Panera Bread. In January, it's only risen 40% of the time, so you wouldn't want to do a bullish position between December and January. But going out to April, Panera Bread has risen 100% of the time. So this helps you select which which options expiration to choose. For a bullish trade, you would not do January, you would do April. Now on the right-hand side of this app, you see strength. This gives you the actual rate of returns for every year between the last 10 years, between 2004 and 2013. And BKE is the buckle. That's the stock being looked at on this example. And as you can see, like for example in March, buckle has risen 90% of the time, and it's been very strong gains, not little gains. So like for example in 2009 it rose 36.4% between December 18th and March expiration. So, and in April it actually rose 63.1% in 2009 between December and April expiration. So I think when you're looking at seasonalities, it's important to look not only at frequency but at the strength, the magnitude of the rate of return. And this app provides you with both of those numbers. And the good thing about the app is it'll let you sort. So you click on any expiration month and then it will sort by the strongest, most frequent gains to the least frequent. So you can see all the 100% gainers, all the 90% gainers. So it's a really good software app. I urge you to check it out on the Options for Income website. And I think you'll be hooked. I certainly am. All right, so let's look at the first strategy for options trading that is an easy strategy. Everyone can do it. It's the most stock-like, but it reduces your risk, and which is very important in the current market environment. It's called buying long-term call options, also known as LEAPs. which it's a stock replacement strategy. And this is, of the three strategies I like, this is number 2, buying high probability growth by purchasing in-the-money call options. Now, an example of a current trade that I like is Occidental Petroleum. Oil's been very strong lately. I think it will continue given all the uncertainty in the Middle East and elsewhere around the world. Right now, Occidental is trading at $100.93. Instead of buying the stock, you can buy long-term call option. The January 2016 95 call currently is trading for $11.25 per share. It expires in 544 days. That gives you plenty of time for this trade to work out, so it's very stock-like. One contract would cost you $1,125 because every option contract represents 100 shares of stock. So the upside break even on this trade is $106.25. You get that just by adding the cost of the option to the strike price. So the strike price 95, it costs you $11.25. So $106.25 is only a 5.3% premium to the current stock price of $193. So this is, this is the downside of buying options, is that you have to pay this time value surcharge. In this case, it's $5.32 more than the stock. Because obviously, if you buy the stock, your break even is $193. When you buy this option, the break even is higher at $106.25. So that's the time value surcharge. But the cost advantage, I think, makes it worth it, especially if you're very bullish on the stock and you think it's going to go above $106.25 in the next 544 days, which I believe it will. So as you can see, the cost advantage, buying one of these LEAP calls only costs you $1,125, whereas buying 100 shares of the stock would cost you $10,093. So the LEAP call is 89% less expensive. It also provides you with downside protection. It's less risky. If the Occidental were to drop 30%, it would be trading at $70.65. Your max loss on the option is only the cost of the option, or $1,125, and that represents only 11.1% cost of the stock. Whereas if you bought the stock itself, you would lose 300 shares of the stock. You would lose $3,028, and a loss of $3,028 is 169% more than the loss on the option, more than double. So there's less risk to buying the option than buying the stock. The delta on the stock is, the delta on that LEAP call option, the 95 call, is 61%, meaning that for every dollar move in the stock, the call option price will increase by 61 cents. So you get a substantial amount of the same stock movement for much less cost, and the longer you hold this towards expiration, that delta is not constant. It will increase up to 100% at expiration. So the bang you get for your buck will increase the longer you hold this call option. Now, so we've established that the risk on the downside is less with the call option. The profit on the upside is also better than stock. As you can see, if the stock were to rise to $115 at expiration, that would mean that the 95 call would be worth $20, right? 115 minus 95 is 20. Since we bought it at $11.25, the profit on that LEAP call would be 77.8%. That's a huge gain. Now you just take 20 divided by the cost of buying the LEAP call, and you get 77.8%. In contrast, if you had bought the stock at $100.93, and it had gone up to $115, you'd only have made a profit of 13.9%. So as you can see, buying the LEAP call option provides you with significantly more profit leverage, 77.8% compared to 13.9%. That's leverage of 63.9 percentage points more of profit for the leap call. Now, this leverage really helps you in your portfolio construction. Let's say you have a $200,000 equity portfolio. Now, reasonable diversification would require 20 separate holdings of 10,000 each. Now, if you were to buy 100 shares of Occidental stock, it would cost you $10,093. And as I said, one Occidental leap call would only cost you $1,125, 89% less expensive. So if you could invest in 20 different stock holdings using this leap call strategy, where each leap call would only cost you $1,125, you could create an entire diversified stock portfolio for only $22,500. So you take 20 positions times $1,125 per leap call option, and that would cost you a total of $22,500. That would leave you with $177,500 of your portfolio in cash. So that shows you how risk-averse this strategy is. You're only risking $22,500, which is only 11.3% of your portfolio value. So basically, you have the same stock upside as buying stock, but with a built-in 11.3% stop loss. That's your maximum risk, which is obviously much less risk than the 100% potential loss from an all-stock portfolio, which would be the full $200,000. Here, you're only risking $22,500. And yet, in each case, stocks, you'll make money from the stock rising. So it's just a lower risk strategy, and it really makes a lot of sense. Now, a medium strategy, which is what most of my options for income trades are selling put credit spreads, or selling irrational fear. Now, this is the first strategy in my three-prong option strategy. You're selling out of the money put options, which you don't think are prices that the stock will actually fall to, but some people are willing to buy protection or willing to buy these puts for insurance. They're fearful, and we can take advantage of their irrational fear by selling those put options to them. Now here, when you sell a put, you're assuming the obligation to buy stock at a certain strike price. You receive a fixed amount of cash up front, and your risk is limited to the width between the put strikes. So for example, if you sell a put at 100, you buy a put at 95, your risk is limited to that 5 points between the two puts. And you know, the stock could fall all the way down to 40 for all you care. Your risk is still limited to that 5-point difference at 100 to 95. And what's great about selling put spreads are the stock price does not need to rise for you to make your maximum profit. Maximum profit occurs if the stock does not rise or even if it falls a little bit. Now, that's a lot better than buying stock where the stock has to rise for you to make a profit. Now, selling puts has outperformed the market significantly during bear markets, which is something that we have to guard against going forward. For example, in the last big bear market between December 20th, 2007 and the market bottom in March 9th, 2009, the S&P 500 ETF lost 52.3% of its value, whereas the buy right, where you buy stock and sell a call against it, the PBP ETF lost only 39.3%. And the put right index, which is that last one, the caret with the PUT, that's where you're selling puts, that only lost 35.9%. So that outperformed all the other two strategies in bear markets. How does it do in bull markets? Well, over the past year, I think you would consider it a bull market between July 18th of last year and the current July 18th. As you would expect, the S&P outperformed because, you know, it's been a bull market, and buy and hold always outperforms in bull markets. It was up 19.4%, whereas the PBP, the buy right, was up 13.8%. The put right index was up 12.9. So even in a bull market, selling puts and covered calls generated double-digit returns. So in both bear markets and bull markets, it's a very solid strategy. Now there is an ETF called the Put Right High Volatility Index. Its symbol is HVPW. It started trading in February of 2013. Now this has significantly underperformed the Put Right Index. The Chicago Board Options Exchange Put Right Index is selling puts on the S&P 500, whereas this Put Right ETF is selling puts on individual high volatility stocks. I think it's interesting that this Put Right ETF has underperformed, even though it's selling very high volatility stocks with very high option premiums. And it just goes to show you that there is no free lunch, that just doing a screen for high volatility stocks that has gives you big put option premiums is no recipe for success, because those individual stocks with high volatility are very high risk. That's why they have high volatility, and those stocks are very prone to blowing up on you. And even though you're selling puts for high premiums, the stocks crash and you end up losing money on a lot of them. So I think this is very educational for people, that you really need to do some fundamental analysis on stocks that you sell puts on. You shouldn't just, sell puts on high volatility stocks, because it doesn't work. So here's a good put credit spread example of one I like right now, using the Options for Income Seasonality Navigator. I found that the 10-year positive seasonality for Apple into September expiration is a very positive 90%, meaning that between July 18th and September expiration, Apple has risen in 9 of the past 10 years. Now, the one single loss was in 2008, when virtually all stocks declined, and that was down 14.7%. But based on this history, Apple does very well between now and September, so I think it's a good trade to consider. Apple is currently, everybody knows what Apple does. They have the iPhone, and it's one of the largest cap stocks in the market. So it's definitely not what I would consider, a high risk small cap. It's a blue chip technology stock. So that makes me even more confident about it. The trade I like right now would be a put spread, where you sell the September 90 put at 210. You buy the September 85 put at 85 cents. So your net credit is $1.25 on this put spread. It expires in 62 days. The potential rate of return is 33.3%. You just take the credit received and divide it by your investment risk, which is the 5-point spread width minus the initial credit received. So your risk of loss is $3.75, which is 5 minus 125. So 125 divided by 375 is 33.3% rate of return, which is very significant for only 62 days. Your break even is $88.75. You just take the strike price of the put you're selling, which is 90. You subtract out your credit of $1.25, and if you were assigned on this, you would be buying the stock at $88.75, which is a 6% discount to its current stock price of $94.43. So this just goes to show you that selling put spreads, selling puts, lets you buy stock at a discount. You never buy stock at its current price. You would only buy stock if it was cheaper than it is today. So that's a lower risk situation. Plus the fact that you make your maximum profit of 33.3% even if the stock doesn't rise. I mean, isn't that amazing? It's still amazing. I've been trading options for 25 years, and I'm still amazed by the fact that you can make a 33% profit by having the stock not go anywhere. Right now with the stock at 94.43, it could actually lose $4.43. by September expiration, and you would still make 33% profit. You can be wrong. I mean, I'm bullish on Apple, but if I'm wrong and it goes down slightly by $4.43, I still make 33% profit. That's amazing to me. All right, so what's the risk of selling puts? Well, although early exercise happens, although it's rare, it does happen. But if it looks likely to happen, we usually can buy back the put and sell a longer dated put. It's called a vertical roll, where you're rolling the vertical spread to a later month. And if you are assigned, you end up buying the stock at a discount, which is a good thing because you're buying it at a discount. That's it's cheaper and it's lower risk. Just so a lot of people are worried that if they're assigned early that they have to have the full purchase price of the stock in their account, and this scares people off from selling puts, but I want you to know that that's not true. You do not need to have the full purchase price of the stock if you sell the stock the same day you are assigned. This is the concept called same-day substitution. Ask your broker about it if you're concerned. Basically, brokers will loan you the money to buy the stock as long as you sell it the same day, and there's no margin call. For example, if you were to sell one of those Apple put spreads, your risk would be only $375. People are afraid. Well, people always tell me, well, what if I had got assigned early on that 90 put and I had to buy 100 shares of Apple at 90? That would mean that would cost me $9,000, not $375, which is the risk. Well, you don't need to have that $9,000 in your account if you sell it back the same day. All your broker requires is that you have that $375 margin on that spread. So I think that's a very important point for people to remember. Now, there are different ways to use this leverage. I mean, there's one bad, one good. The bad way is to buy more options for the same amount of cash as buying stock. So, for example, if you were to normally buy 100 shares of Apple for $9,443, you could sell 25 put spreads for the similar risk of $9,375. That would be 25 times the exposure to Apple for the same cost. That's not the way to do it. That's a bad idea because, if Apple were to fall to 85 or below, you would lose your entire $9,300 investment, whereas if Apple fell to 85 with the stock, you would only be out, about 11% of the stock. So options are leveraged, so they can lose 100% of their value. So you definitely don't want to invest the same amount of cash in options as stock. But what the leverage does allow you to do is to buy the same amount of stock for much less money. And that's the way to use the leverage. So you can sell one Apple put spread for $375 of risk, which represents the same 100 shares you would have bought with the stock, and yet it's 96% less risk because $375 is a lot less than $9,443. So what this leverage lets you do in a good way is to open up 25 different put spreads for the same price as one 100-share stock position. So the good way to use leverage is to use options to optimize your portfolio diversification. Instead of buying 100 shares of one stock, buy 25 different stocks for the same amount of money. So for example, using a put credit spread strategy to construct an option portfolio. Let's say you have a $125,000 equity portfolio with reasonable diversification, 20 holdings of $6,250 each. And let's say you expect a portfolio return about 10%, or you want to get $12,500 per year in profit from in return from your portfolio. If you were to do 50 separate positions of a 2-contract put credit spreads at per contract income of $125 and per contract cost of $375, you would yield the same $12,500 of income that you would from your stock-only portfolio, but the investment risk would be only $37,500. You take 50 positions times 2 contracts per position times $375 per contract risk. That would cost you $37,500. That would leave you with $87,500 of your portfolio in cash, risk-free. Maximum dollar loss on your put spreads would be, 100% of the options, which would be $37,500, which would be a 30% hit to your portfolio. That's very unlikely, but that would be your maximum worst-case scenario. It's still much better than the worst-case scenario with a stock portfolio, which is 100% loss of your entire $125,000 portfolio. So 30%, $37,500 loss versus a potential $125,000 loss. Chance of suffering maximum loss on all 50 put spreads is infinitesimal, so this is just worst case. Whereas the chance of losing 30% of your stock portfolio is definitely possible. So I think the risk of this put spread diversification is much less than stock only. And yet the probability of making $12,500 income with the put spreads is much higher than buy and hold stock because the put spreads do not require the stock to rise, whereas the stock would have to go up 10% for you to make that money. So both on the downside and the upside, this put spread strategy is superior to stocks in my humble opinion. Okay, lastly, I'm running out of time. I got about 5 minutes left, so I'll just briefly go through iron condors, which is an advanced strategy where you both sell a put credit spread, which is the irrational fear, and you sell a call credit spread, which is the irrational greed. This is number 3 in my option arsenal of strategies, and number 1 and 3. So this is a historical example. I don't have a current example trade for you because I think volatility is going to increase, and I'm not sure iron condors are a good strategy right now. So I'll just tell you a historical example that I offered to my Options for Income subscribers back in May, and also to our Wealth Society conference of our best Investing Daily subscribers. It was AutoZone, and it was May 2nd that I recommended this, and it was going to expire in June. And as you can see from the Seasonality Navigator software application, AutoZone doesn't move that much in between May and June. All of the numbers are single digit except for 2005. So it doesn't move much, which is what you want with an iron condor because you want it to stay within a range and not move either too far up or too far down. So in the case of an iron condor, frequency up or down is not important. What's important is magnitude of the moves, and you want them to be low. And as I said, in AutoZone, it had very low magnitude moves. Only 1 out of 10 was double digit. So based on the fact that in 9 of the 10 years, AutoZone moved 7.2% or less, a good iron condor strategy would be to choose short strikes 8% out of the money, both up and down. So you'd sell a put option 8% below the current stock price and sell a call option 8% above the current stock price. This is what AutoZone looked like in on May 2nd, and you can see that it was in quite a narrow trading range between basically February and the end of April. So what we would do is you would try to you would try to do a put down here at the bottom end of the channel and a call on the upper end of the channel. That's where you would try to do your iron condor and hope that the stock stays within that range. Okay. So the trade I recommended back then expired in 50 days, and it was selling the 480 put, buying the 470 put, selling the June 570 call, buying the June 580 call. With a net credit of 180, potential rate of return was 180 over 820. 22% gain in 50 days is not bad. Break even was 478 on the downside, 571 on the upside. And you'd make your maximum profit as long as it stayed between 480 and 570, which is a pretty substantial 90 wide range. What's great about iron condors are you get a double credit and yet you just have a single margin requirement. you can't lose on both of the credit spreads. You're guaranteed to win on one and hopefully both, but you'll definitely win on one. So your margin is limited to just the more risky of the two credit spreads. So what happened? AutoZone closed on June expiration at 530.79, so it was a winner. Closed 530 is in between 480 and 570. So my subscribers are very happy with that. Just to summarize, my long-term call option recommendation is buying the Occidental Petroleum January 2016 95 call for a debit of 11.25 or less. My short put spread example is selling the Apple September 90, September 85 put spread for net credit of $1.25 or more. And okay, I don't have time for my downside protection hedges presentation, but it'll be on. I think it'll be on the website since I'm donating this whole presentation, so you can look at that at your leisure. So again, if you're interested in my low risk, risk averse option strategies, you can go to Jim Fink Options for Income website. www.investingdaily.com/webinar. We have a 90-day money-back guarantee, so there's no risk to you. Just sign up, and if you're not 100% satisfied, you just cancel within 90 days for a full money-back refund. But during that 90 days, I think you'd be very benefited by checking out all of the trades that I've done. I have over an 80% win rate. Definitely a positive expectancy. The portfolio has made money every year since inception in April 2011. And probably most important of all is you'll have access to the 10-year Seasonality Navigator, which you can't find anywhere else. And you can make your own trades or whatever. And just an amazing data resource for finding out which stocks are likely to rise between a certain start date and the next 6 options expiration. So just for the Seasonality Navigator, it's worth checking out the website. So with that, I want to thank everyone for coming to my presentation, and looking forward to chatting further with any of you at any time. Thank you very much.